Right now, the market is jittery and moving fast. Prices are swinging, big players are taking bold bets, and the noise around Jackson Hole is making traders rethink everything. If you want clear, no-fluff breakdowns that cut through the headlines and tell you what really matters, stick around and subscribe. Hit that bell so you don't miss the next update. I'll walk you through 3 hot stories that are driving crypto sentiment today, explain the facts, give a calm, practical analysis of what they could mean for price action and risk, and leave you with a few questions to discuss in the comments. Bitcoin slipped under $114,000, and Ether fell back through the $4,200 level after traders grew cautious ahead of Federal Reserve Chair Jerome Powell's speech at Jackson Hole. Markets had been riding a surge earlier in the week, but a stronger-than-expected inflation print and chatter that Powell might sound more hawkish than hoped forced a reevaluation of the timing for a Fed rate cut, and that uncertainty translated quickly into selling pressure across crypto assets. The immediate impact was a notable pullback from recent highs. Bitcoin's retreat erased a chunk of the short-term gains, and altcoins, including Ether, saw steeper percentage declines as leveraged positions unwound. This isn't just headline noise. When macro actors price in a higher-for-longer rate environment, risk assets like crypto typically suffer because future cash flows and risk premia are repriced. The practical takeaway for traders: volatility will likely remain elevated until Powell's remarks are passed and the market digests whether a September cut is still feasible. On a technical level, these drops often trigger stop-loss cascades and liquidations that exaggerate moves in the short term, so expect sharp intraday swings and quick bounces as liquidity providers step in. For position sizing, this is a reminder to tighten stops or reduce leverage if you're exposed. The macro backdrop suddenly shifted, and that changes the risk calculus. Jenny Johnson, CEO of Franklin Templeton, a firm overseeing roughly $1.6 trillion in assets, laid out where she thinks investors should focus in crypto, and her remarks are worth paying attention to because of the sheer scale of capital her firm manages. At a public forum, she emphasized that the most compelling long-term bets aren't just on headline coins, but on the infrastructure, custody, and picks and shovels plays that enable blockchain adoption, services and technologies that persist regardless of which token leads the next cycle. That viewpoint aligns with other large managers who see durable revenue streams through custody, tokenized products, and enterprise blockchain use cases. The market impact of a message like this is twofold. First, it signals institutional appetite for regulated, productized exposure to crypto beyond pure speculation. Second, it can direct flows into service providers, ETFs, or tokenized funds rather than into high-beta altcoins overnight. For retail viewers, the key point is diversification of approach. If your horizon is institutional or multi-year, consider exposure to firms and products that extract fees or provide infrastructure rather than betting everything on a single tokens. Price appreciation. If you're focused on trading, recognize this narrative can support mid-term resilience for the sector, but won't prevent short-term volatility triggered by macro events like Jackson Hole. For listeners who want names or vehicle types to watch, look at custody providers, tokenized asset managers, and regulated ETF filings from major managers. Those are the channels likely to attract capital as institutional comfort grows. On-chain and derivatives activity shows big whales still place confident wagers. An Ethereum whale reportedly opened a $1635 million long on ETH using high leverage, a move that signals conviction that this dip could be the buying opportunity some traders have been waiting for. Specifically, that long was sized with significant leverage, indicating the trader expects a sharp bounce rather than a long grind upward. Leverage magnifies both gains and losses, so the presence of such a large, leveraged long can influence intraday liquidity and short-term price dynamics. If Ether starts rising, leveraged longs can force shorts to cover and create a squeeze. If Ether falls instead, that position risks fast liquidation and could add to downside pressure. Technically, analysts are watching whether ETH can reclaim key levels above the recent support zone. A decisive reclaim could propel a rebound toward intermediate resistance bands where momentum traders will re-enter. But the behavioral lesson is important. Whale activity can move price and amplify trends, but it's not the same as a change in fundamentals. Watch order books and derivative funding rates. A cluster of big leveraged longs increases tail. Risk and volatility. For risk managers, that means either keep leverage low, set clear liquidation thresholds, or use hedges like options or inverse exposure to protect against a sudden snapback. This whale bet highlights both the optimism and the fragility in the current market setup. Optimism because someone is willing to take a sizable directional risk. Fragility because leverage can turn an otherwise contained move into a fast cascade. Synthesis. And real talk, put these three stories together and the narrative becomes clear. Macro uncertainty from Jackson Hole is the near-term trigger that pushed prices down. Large asset managers are publicly outlining a more durable, infrastructure-driven approach to crypto investment, and large speculative bets on Ether show traders are actively searching for a bounce. That mix produces a classic market regime: headline-driven volatility with pockets of structural, longer-term interest. For investors, that means two parallel playbooks may make sense simultaneously: a shorter-term, risk-managed trading approach that respects higher macro volatility, and a longer-term allocation strategy that targets infrastructure and institutional adoption themes. If you're trading, reduce leverage and use tactical stops. If you're investing, consider diversified exposure to custody, regulated funds, and tokenized vehicles. And remember that allocation should reflect your time horizon and ability to withstand drawdowns. Tell me which story matters most to you in the comments. Are you most worried about Jackson Hole and macro risk, excited about institutional products from big asset managers, or intrigued or concerned about the giant? Leveraged ETH long? Drop your take and why, and if you found this breakdown useful, make